Stock markets crashed on October 19, 1987. In what became known as Black Monday, the Dow plunged more than 22.5%, its largest one-day collapse in history. Of course, the Dow has risen dramatically during the last 35 years. If you're keeping track, it's more than 1,600% higher. But that's certainly cold consolation for anyone who has been keeping an eye on their 401k this year. According to a recent Bank of America analysis, stocks are anticipated to tumble further until 2023. Similarly, Citibank also predicts markets are increasingly betting on a recession. So what can we make of all the signals the stock market is sending right now? And is a possible market collapse imminent? Stick to the end of the video to find out more. Following positive earnings reports from several companies, U.S. stock markets went on a rare winning run in early November. However, the Federal Reserve's recent 0.75% rate rise and the comments threw the stock market into a tumble. Stocks rose soon after the Fed's press statement was issued Wednesday afternoon, but subsequently plummeted. One statement in the press release: the committee will take into account the lags with which the monetary policy affects economic activity and inflation, offered investors confidence that the Fed may decrease the pace of future rate hikes. Then, at a news conference, Fed Chairman Jerome Powell stated that rates would most likely end up higher than the Fed had planned. The market plummeted as a result of this news. This new wave of volatility is simply another indication that investors are unsure of what will happen in the next few months. With September CPI data indicating stubbornly high inflation, the Fed has made it plain in previous meetings that it wants to make lowering inflation its top goal, even if it means a higher unemployment rate. I think we probably are going to be facing a recession because the Fed has explicitly said that's what it needs, says Brad McMillan, CIO for Commonwealth Financial Network. That's a dismal forecast in what has already been a difficult year for the stock market. Since the beginning of the year, the average U.S. mutual fund, or OTF, is down 17.3%, and the market has seen many instances of daily and weekly losses at their highest level since the pandemic. Investors are quite anxious about how much worse things may become in the coming months, given recession worries, high inflation, and high interest rates, making things difficult for firms and individuals alike. In 2021, the economy increased by 5.9%, as measured by gross domestic product, which was the fastest annual rate of growth since 1984. The Fed's monetary policy move is meant to slow the economy in order to mitigate the inflation danger while avoiding a recession. In 2022, the economy slowed significantly. Annualized GDP fell by negative 1.6% in the first quarter and negative 0.6% in the second quarter, before turning positive for the first time this year, rising 2.6% in the third quarter. Despite slowing GDP growth and the Fed's effort to cool the economy, employment creation was strong in the first 10 months of 2022. Non-farm payrolls increased by 407,000 jobs each month on average. However, the rate of growth has decreased in recent months, albeit remaining positive. The Fed's aim to overcome inflation may be the biggest threat to the economy. Despite the Fed funds rate being raised by 3.75% to 4% thus far in 2022, inflation remains strong. The Consumer Price Index, the standard measure of broad inflation, climbed 8.2% year-on-year through September. Despite being lower than the peak change of 9.1% in June, investors appeared concerned that the decline was not more serious. Fed money tightening and increasing inflation has kept the stock market volatile for most of 2022. The stock market's performance has fluctuated dramatically from month to month. Market fundamentals, such as business sales and profitability, will be an additional source of concern in the future. A major question is whether higher wage costs hurt companies' bottom lines. Companies have been able to maintain earnings levels to date because they have been able to push through price increases, Haworth explains, but can they keep doing that? According to Eric Friedman, a chief investment officer of the U.S. Bank, it is critical to keep a proper perspective on the environment. He warns that markets are likely to remain turbulent. Nonetheless, he advises investors to keep a long-term perspective. Timing the markets and trying to be precise on when to be in and when to be out is challenging, says Friedman. markets will do things at the exact opposite time you expect them to. So will the market actually crash in 2023? The Federal Reserve's monetary policies are at the center of most discussions concerning the likelihood of a recession. However, there are supply-side forces that might push the U.S. economy into a recession. Among these are the Biden administration's tax and regulatory initiatives. A decline in employment is sometimes used to characterize a recession. Other times, it is defined as a decrease in real GDP for 2 quarters or more. A strong labor force, productivity growth, and recovery from the pandemic are supply-side variables that reduce the likelihood of a recession. However, higher regulation and capital taxes, 2 Biden administration policy goals, are supply-side headwinds that raise the likelihood of a recession. Adult population increase is often a positive economic driver. However, it dropped significantly between 1980 and 2018, from more than 1% to around 0.4%. President Trump's severe immigration policies, including those affecting legal immigrants, are largely to blame for this fall. President Biden has not done anything to change these policies. The recovery from the pandemic has also been a blessing. It will continue to boost employment, but most of the rebound has already occurred. During the pandemic, workers lost skills and capital was idle. These are recovering, albeit technically speaking. Their recovery will not be completely reflected in the growth numbers. During the pandemic, GDP and productivity levels were overstated because many goods were unavailable or poor quality in ways that GDP figures did not convey. Even if public school teachers stayed at home, national accountants thought that they were as productive as ever since they were still paid. Workers' productivity grows by roughly 1% in typical years. That alone is a powerful economic tailwind, driving GDP growth, making recession by the narrower definition of GDP less likely than otherwise. Unfortunately, Biden's economic policies are likely to reduce productivity growth. According to a 2020 study, Mr. Biden's economic agenda would cause full-time equivalent employment per capita to be 3.1% lower than otherwise, and real GDP per capita to be 8.5% lower than otherwise. If that effect were stretched out across 5 years, the annual decreases in comparison to baseline growth would be 0.6% and 1.7% respectively. That alone makes a recession in one of those 5 years possible. Biden's regulatory strategy appears to be proceeding as planned. The Senate has rejected the president's nominee to the Labor Department's Wage and Hour Division, David Weil. However, Mr. Biden's mask rules nullify that positive news by disrupting hiring and staff retention at a time when supply chains are already stretched thin. His regulatory agenda is expected to reduce employment growth by 0.2 percentage points per year and real GDP growth by 0.7 percentage points per year. Biden's Build Back Better measure would raise capital taxes, but it is unlikely to pass. High inflation, on the other hand, is raising capital taxes without any action from Congress. Biden is almost expected to let the temporary capital taxation measures in the 2017 tax cut legislation expire. The result will be to lower real GDP growth by around 0.4 percentage points each year. Increased regulation and capital gains taxes combined reduce employment growth by around 0.25 percentage points per year and real GDP growth by about 1.1 percentage points per year. Labor taxation is a wild card. The $300 weekly unemployment compensation imposed an implicit tax on labor. If you found work, you forfeited the bonus. Because the incentive ended last summer, the implicit tax rate on work has decreased. Unfortunately, when economies enter recessions, politicians from both parties often raise unemployment benefits in order to do something. If it happens this time, employment might be reduced by 1% or more very soon. A recession appears to be reasonably possible only from the standpoint of demand. Unfortunately, the government's supply-side policies appear to be designed to foster one. Where do you think the market is headed? Let us know in the comments below. If you enjoyed the video, hit the like button. Also, don't forget to subscribe to our channel and hit the notification bell if you're new to the channel, so that you get notified when we upload more content.